Day in and day out, the same routine. Waking up early, battling traffic, and clocking in for yet another 9 to 5 grind. Feeling trapped in a cycle that feels endless? You're not alone. Many dream of breaking free from the daily grind. But what if you could take control of your life? What if you could trade that routine for financial freedom? Welcome to FX Fabric, where we weave together the art and science of Forex trading. Join our exclusive Forex trading marathon and transform from a curious beginner to a confident trader. Every week, we're rolling out 2 brand new videos, starting with fundamentals. Learn the basics of fundamental analysis, candlesticks, and chart patterns. Discover how to identify trend lines, support and resistance, and key indicators that drive market movements. As we progress, we will delve into advanced strategies like supply and demand, fake breakouts, and liquidity sweeps, and more. By the end of our marathon, you won't just understand Forex. You will be a profitable trader, ready to conquer the markets. All right, welcome back, guys, to FX Fabric. This is Moses, and yeah, today is another day. Today we are going to be studying candlesticks. I'm starting a new series, and I will be discussing with you guys theoretical parts of trading, and we shall be beginning from zero up to more advanced methods of trading. And yeah, why am I beginning from candlesticks and such simple theoretical parts? Is because, guys, many times we think we know these simple things, but in fact we don't really understand them fully, and you need to revisit them. Just like any other profession, let's say medicine, let's say an engineer, you always need to revisit sometimes certain concepts in order to master them. Exactly. I know many of you guys out there, you know what a candlestick is, you know what each candlestick may mean, but yeah, with time you forget them. So this is to remind you, for those who are coming, who have some knowledge about trading, but for those who have not started yet trading, you are just confused, like all of us started, and you're looking for information about trading. This is a very nice place to begin with. I'm going to be taking you throughout what a candlestick is made up of, what types of candlesticks exist, and what should you do when you see certain candlesticks, and what's the psychology behind a candlestick. Why does it have a wick? Why does it have a big body? Why does it look like this? The next lesson tomorrow, well, it may not be tomorrow, but the next video to post, I will actually create a playlist, and the next video will be about candlestick patterns, because there is one thing having one candlestick, and it's another to have 2 types of candlesticks appearing at the same time, and they mean something different. Yeah, so guys, let's jump into it. Let's not waste any much time. So let's look at a candlestick structure. What is a candlestick and what is it made up of? What you should know is that Japanese candlesticks, they were created by a Japanese trader. He monitored actually the way Japanese used to trade in the Japanese market, and yeah, he managed to understand the behavior of these traders and the trends of prices of cereals, of rice, of everything, and brought all of them together and found patterns, behavioral patterns actually, because most of it is actually behavior and psychology. Behavioral patterns of traders, how they behave when they see certain prices, and what prices do they deem high enough, what prices do they deem low enough. You understand? And that interaction between traders, he managed to bring it together and create a candlestick. So what is a candlestick made up of? A candlestick has a body, and guys, if you open any graph, you'll find such that this is what you mostly find in most graphs. You'll find a body. Let me actually increase it in size. Just a minute. Just a minute. Okay, guys. So let's begin. You will find a body. And what is a body? The body is where most of the trading takes place. And literally, that is, if it's a green candle, that means within that time frame, because most candlesticks are in a time frame. There is a 1 minute time frame. There is a 5 minutes time frame. You can actually find these days 2 minutes, 3 minutes, 5 minutes time frame, 15 minutes time frame, 30 minutes time frame, 1 hour time frame, a day, a week, 4 hours, sorry, a day, a week, a month, up to a year. So, sorry. So when you see such a candlestick, it shows you the trading, how much trading took place within that time frame. For example, let's say this is a 1 hour time frame. It shows you how much trading took place within this time frame. You can see this is a very massive candle. You can see. So there is what we call the open price. And guys, the open price of a candle, if it is a red candle is a bearish candle, and a green candle, in this case I'm using blue for green, not to confuse you. So if it's a red candle, the open price is always at the top here. You see, because why is it at the top? Who are bears? Bears are people who are selling. They consider the market is going to fall, and they consider the price they're having as too high. They consider the price they have as high enough for them to sell and take off profits. You understand? So this candle, for example, it opened at this point, and all the traders who came into this market, not all of them actually, but most of the traders who came into this market, they had a bias which says that the price is too high. You understand? Considering deeming the price too high, they prefer to sell. Let's say you have a phone, you have an iPhone, and one day, let's say the iPhone, instead of costing $1,000, people start to buy it at $2,000. What will you do? You deem that price so high that you're ready to take profits. You understand? At that price, even with you, with your own iPhone, you can sell it to go and buy another one. You understand? To go and buy another one at a cheaper price. So that is what happens at this case. The open price is the price just at the beginning of that time frame, and you can see that it opened bearish and the bears pushed the market first to the top. So pushing the market to the top, that shows you that at first buyers stepped in. They wanted to push the market higher. They created a high here, but bears stepped in and they pushed the market further below, which means that the buyers didn't have enough pressure to push the market further high. You can see this wick here. The length of the wick can always determine the strength of the buyers or the sellers, and the size of the body can always determine who is in control of the market. Look at this candle, for example. It is a massive bearish candle, and as you can see that once the bears stepped in, you can see how far they pushed the market all the way to this point. So they pushed the market all the way to this point, and this is where the market closed. But before it closed, what happened? This market started from here. Let's go back again. We started at this point. The buyers pushed it up high. The bears stepped in. They pushed the market down all the way to this point, creating this low. And then the strength of the bears weakened as the buyers started to come back into the market. You see, they pushed back on the bears. Sorry. And then you can see that by the end of this time frame, let's say by the end of the hour, if this was 1 hour, by the end of the hour, the market was around this area. You can see. So the closing price is the price at which the market closes by the end of that time frame. So you can see what is going on within this. A lot of psychology is going on within one candle. You can see. Now, as you can see, guys, look at how large this candle is, and it's red. What does that show you? It shows you that it tells you who has dominance on this market. It is the bears. Though the buyers stepped back in here to push the market a little above. Looking at the size of this candle, it still shows you that the bears are still in control. You can see, guys. So that is both a candlestick. We have seen that a candlestick is made up of the open price, the high of the price, the body, the close price, and the low of that candle. And then it has what we call a wick. The wick are those, you can call it a tail, you can call it whatever you want, but there are those tails which remain outside the body of the candle. And what do they say? They also have what they mean. They mean that the opposite people came to step in to push that candle back and close, like to reduce the body of the size of that candle. You see. Let's move on to the next. Aha. The next one is a hammer. Guys, a hammer. What is a hammer used for? No, let's just put it in simple terms. A hammer is used to nail something, literally. If somebody says, I'm going to hammer you, don't joke with him. He's going to nail your head. You understand? So a hammer is used to nail something down. You understand? Now, when you see such a candle, always remember what that means. That, let's say you want to attach a wooden plank onto this board. What do you use? Use a hammer. So the hammer is used for that. So let's go back to the hammer. Same thing. We have two wicks here. We have the upper wick, the lower wick, and then we have the body. This kind of hammer, as you can see, the hammer can be red, it can be green. In this case, we are using blue. What does that mean? That the hammer can be a bearish hammer, as you guys can see in this area, this yellow area, or it can be a bullish hammer. A bearish hammer appears, it can appear anywhere. Guys, what you should know about hammers is simple. No matter what the color it is, it can always appear anywhere on the graph. But the information it gives off is a little different. You understand? Depending on the color of the hammer, the area where it appeared, and the reaction of what happened after that hammer. But let's first go deep into what a hammer is made up of. So as you can see, let's begin with the bearish hammer. The market was moving down like this. This is the same. Sorry guys, this is the same candle we looked at. So this is a downtrend. The bears had dominance. They sold, they sold, they sold, and all of a sudden you can see that these candles started to become smaller. This candle, I would have showed you, let's see, on the previous. This is the candle, for example, this is the candle we were looking at. So on the next one, you can see that the next candle became smaller, and the next one even became smaller. And look at the size of this wick. What did I explain to you guys? When you see such a wick, that means that the seller stepped in, the market opened here, we sold the price, came all the way. Look at how far we came to bring the price. We brought the price all the way down to this level. But this wick here, you see, that is a lot of resistance which came in from the buyers. So when you see a wick like this, that means massive wick like this. That shows you that the buyers massively stepped in. They rejected that price. They deemed it so low that they feel it is a good price to buy. So after deeming this price so low, the buyers massively stepped in and they feel, wow, what a good price to buy. Let's say you're selling eggs. And let's say one egg, a crate of eggs was costing, let's say, $20. And then all of a sudden, in 1 hour, you come back and that crate costs $15. You see, what will you do? If you are a trader, if you are a person who works, let's say, in the market, of course I will buy. What are you talking about? I'll buy it and go and resell it at $20. So that is what the buyers are looking at. That looking at this price coming so low to this level, there are other indicators why some buyers stepped in here. Those are advanced concepts. But you can see that they stepped in and they deemed this price so low, stepped in and then pushed the price back to this level. So looking at this hammer, you can see where it appeared. Hammers normally appear at the end of a trend or at the beginning of a trend. When you see hammers appear in a trend, be very careful. When you're trading, that simply means that trade is losing momentum or the opposite side is trying to step in. In this case, look at this thing. we've seen that we've got a massive bearish candle here, followed by a smaller but also massive bearish candle, then further followed by a massive bearish candle here, but also smaller than the previous one, and then a hammer. You can see, guys, and then a hammer. As you can see, guys, this hammer has a long wick which is facing downwards, and then a shorter upper wick, and then a small body. That is the characteristic. Those are the characteristics of a hammer. It has to have a long wick on one side, longer than the wick on the other side, where, like, I can say 2 to 3 times longer than the wick on the opposite side, and a small body. That's what makes up a hammer. It can face any direction, guys. It can face up or down. Wherever it appears, it will have a similar effect. So that is a hammer for you. And remember what I explained to you. This wick just shows you how buyers stepped in to push the market back because they deemed this price so low, so low. What happened next? Actually, I'm already going into price action. What happened next? We saw other hammers. 1, 2. I can't call this a hammer, but look at all these dodges. Look at all these dodges. And this is a simple candle. Another hammer at this place. And look at what happened after here. You can see. So we formed a bearish hammer at the end of a bearish trend, and at the beginning of a bullish trend, we formed what do we call this? A bullish hammer. So a combination of these things here should tell you where the market is going, and you can easily make money of these areas here. So we've seen a hammer. What else? Guys, I hope you're paying close attention to the psychology behind these candlesticks, because it really tells you what is going on. What is going on behind this battle, because trading is a battle. When you know what you know about trading is that when you're losing money, somebody else is getting that money. Why? Because trading is made up of buyers and sellers. If you sell something, there is somebody on the other side buying it. You understand? So types of hammers. We have what we call a hanging man. Who is a hanging man? This is a hammer. It's a bullish hammer, but it can also be bearish. So it's a hammer which has its tail facing down, and it's normally on the top of a trend, uptrend. If we have an uptrend going like this, and then we find a hammer whose tail is facing down, that is what we call a hanging man. You can see, guys, and that hammer appearing at that top, it can also be a sign of reversal. You see, guys, but if the hammer, the tail is on the top of an uptrend, that has more significance. But one thing you should know about, guys, about hammers and dodges is that whenever they appear in a trend, they always have meaning. And watch out the next price action which happens after that, because they always tell you what is going to happen next. No matter so this is a hanging man. It's happening because let me explain it very, very quickly. If this hammer here appeared at this area, look at this hammer here. This is also a hammer. But if this hammer appeared at this area, we could have called it a bearish hammer, though it's bullish. You see. But if it appears at the bottom here, it has more significance. Why? Because it shows you that this market can easily reverse to the top. But look at it. We pushed up here, and instead of the buyers stepping in immediately to push the price to the top, sellers, after the open price here, the sellers stepped in and pushed the market further down, covering more than half of the previous candle. What does that tell you? That tells you that after an extended uptrend like this, we see 3 big massive candles. And once you see such an extended trend, always expect sellers to come in after some time. So we see that sellers are starting to come in. It should be a reminder that if you are in a trade, if you have 2 trades, at least close one. If you are in a trade, be very careful. Move your stop loss into profits, because sellers are coming. They are coming for you. So you see this hammer, it comes like this and closes. You don't do anything. You see, guys. And then the next candle comes and prints a massive bearish engulfing candle. So if you didn't pay attention to this hammer and you had entered the price at this area, you would have lost all this. You understand? So always pay attention, guys. And you can see the size of the wick. Most of you guys are used to the hammer forming the wick, the body at the top. Sorry, the wig at the top, and then the body here. No, even this hammer is valid. It giving off a reversal at this point is very valid. That's why I actually use this hammer as an example. Anyway, the hanging man is done. Let's look at the next. We have a shooting star. A shooting star, what is it? So a shooting star is literally an inverted hammer, and it can appear anywhere, guys. It can appear at the top of a trend, or it can appear in the middle of a trend, or even at the bottom of a trend. But I want to highlight that these hammers normally appear at the end of an uptrend. The trend has been moving up, moving up, moving up, and then the candles start becoming smaller, smaller, smaller. And on the final run, you can see, guys, we are moving up, moving up, moving up. We formed a bearish engulfing candle here. We shall discuss what a bearish engulfing candle is, but we form a bearish candle here, a red candle. The sellers step in. They give you a signal that we want to come in. But not all sellers have finished. You can see, like, they haven't taken over yet, but they are stepping in. And what happens when you see such kind of movement? Just know the price is going to change. So the buyer stepped back in and they pushed the market. You can see how massively they pushed it, even beyond the previous high. And then sellers stepped back in to push the market, and the price closed way. So you can see how the closing price came way closer to the opening price. You see here. So you can see that there is a lot of resistance from the sellers. They stepped in and pushed the price back down, hammering and nailing the price at the top up there. So what happens next? The sellers have to gain control. The next candle will tell us whether the sellers are fully in control or not. So we come here and form a massive bearish candle compared to the previous one. This is still a massive bearish candle. You can see. And the combination of this, guys, if you know what it is, tell me, comment. We shall be coming for the next video to know what the combination of this is and how it affects the market and how you can tell this movement, guys. So you can see this combination. Very beautiful combination for you to get a sell. But comment down there what it's called, and I hope all of you know it. But if you don't know, wait for the next video and we shall tell you what this is called. This is like perfect combination. So that is the shooting star for you guys. The next candlestick is an inverted hammer. So as you can see, guys, an inverted hammer looks like a shooting star, but it happens within a trend at the bottom of a downtrend. You can see, because we are used to a normal hammer standing down here with the head around this area. But in this case, it is the opposite. Look at it. We are in a downtrend. The sellers pushed the market down, and then they made a last race to push the market further down. So what happened at this last race, and actually these last runs, they always print very massive candles, and the market gets rejected immediately. If you know, the further we go into trading, I will explain deeper concepts, supply and demand, rejection zones, and how you can spot those zones when the market is rushing into a certain zone and gets rejected immediately. But anyway, an inverted hammer, it appears mainly in a downtrend at the bottom of a downtrend. Mainly. Don't be surprised if you see it in the middle of an uptrend. But why do I say mainly at the bottom of a downtrend? Let's explain the psychology behind it. As you can see, guys, from this previous candle, for example, where is the opening price and where is the closing price? In this case, let's begin from here and read the candlestick. The price opened from here. We pushed the market to this area. The buyers pushed the market to this area. Sellers stepped in and pushed the market all the way to this area. And finally, by the time the market closed, no, I can say by the time the time frame closed on this candle, if this is a 1 hour, by the end of the hour, the price was here, and that's what we call a closing price. The next candle opened, and you can see that the buyers were not so many. Look at the size of the wick here. There were not so many buyers. The sellers stepped in immediately. You can see the intensity of the sellers. They stepped in and pushed the price way massively down, all the way to this point. You can see this pointy part. That is the wick. And then by the end of this trading time zone, this is, for example, 1 hour, the market closed at this area. Next candle, we opened at this area, and then what happened at this area? We pushed fast. The price pushed up here. You can see, guys, this is the opening price, and then we pushed all the way up to this area. Who pushed the market up to that area? Those are buyers. And how far did they push it? Look at the size of this candle, guys. This is a very massive candle, let me tell you guys. If you've seen all the candles along the way, this is a massive candle, but look at how far the buyers pushed the price, almost to the opening price of the previous candle. And then the sellers resisted and pushed the market back again, going all the way through the opening price to a little below this area, you can see here. And by the time the 1 hour finished, we closed very close to the opening price. So as you can see, we closed at this area, and that shows you that buyers have interest because they managed to push the price all the way, almost covering the entire previous candle. The buyers have interest, and they have stepped in. They have shown their interest. Yes, they have stepped in. This candle closing red doesn't mean there are no buyers there. Actually, all these candles, guys, you see here, they have buyers in them. Just the sellers are more than the buyers. So in this case, the buyers are showing more interest. Let's look at the next candle. On the next candle, we come, where did we open the price? Always, guys, remember the opening price. Where did we open from? In this candle, actually, we opened here. You can see, guys, we opened right at this area here. And what happened? The sellers tried to push the market way below to this area. But the buyer stepped in and resisted that movement and pushed the market all the way up to this area here. You can see, guys, here. And then the seller stepped back in again to kind of counterbalance the buyers. But you can see this candle closed positively, like it closed a bullish candle, which means the buyers had control. But this is not still convincing. You wait for the next candle. Guys, this is already going into trading. But if you wait for the next candle, you can see the intensity of which the buyers are stepping in slowly by slowly till when they massively take over and push the market upwards. You can see, guys. So such candlesticks have a lot of meaning. And once you understand what's behind them, you can really play around with them and make money. Dojis. So I really don't know where the word doji came from. I don't know how to explain it. But we have a candlestick called a doji. And a doji is literally a candle which has more or less equal wicks and a very small body. If not, the body doesn't exist entirely. So you can just see a line, a cross. You guys who are Christians, it's literally a cross. There is no body, just lines like this, equal on both sides. Sometimes not equal, sometimes one is longer than the other, but more or less equal. You can see, guys. So that is a doji. And what explains a doji is simple, that the buying force is equal to the selling force, which means that the intensity at which the sellers in this case, for example, let's say the buyers came, they pushed the market all the way to this level. And when we reached at this price, who stepped in first? Think about it. Who stepped in this first in this area? We are in an uptrend. And since we're in an uptrend, that means the buyers first pushed the market all the way to the top. And then the sellers are like, nah. We are not going any higher. We can't accept that price. It's too high. And it's not that they can't accept the price, but once the buyers push the price up here, the sellers looked at it and like, whoa, that is a very good price to sell. They started selling, and look at how far they pushed the price, all the way on beyond the middle of this previous candle. And then the sellers are like, well, the price looks quite cheap, and we think more buyers may step into the market. So the buyers come back into this market and push the market all the way to the opening price. So in the end, the opening price is equal to the closing price. So we have something like this. So if this is the opening price, this is the closing price, they all come together and equate to one another. So we get a doji, which is in most cases, the opening price is equal to the closing price. So you don't see a body on the candle. The wicks can differ. Some of them can be longer, others can be shorter. We shall look at them. And that candle, it shows you, I've explained the psychology behind it, but it shows you indecision. What is indecision? It means nobody is in control of this market right at that moment within that time frame. Let's say it's 1 hour. It means by the close of that time frame of that 1 hour, neither the buyers nor the sellers could take control of the price. So they all, it's a draw. It's like playing football and draw. You guys who know football. Let's go to the next one. Types of dojis. Look, you can look at them. We have spinning tops. We have this kind of doji here, and they can all appear at any point in the market. For example, if you look at this doji, look at which side is taller. If you look at the top, for example, here, this is almost equal. I can't say it can mean much. But if you look at this one, the lower side is longer than the upper side. And what does that show you? That if the opening price was here, the seller stepped in to push the market below here. And look at how far they pushed the market here. So if this has been an uptrend, we printed an uptrend here, a candle here, a bullish candle here, and we get such a massive doji, and it closes up here, you will be fool not to get out of this market if you are buying. So no, guys, let's just think about it. It's an uptrend, right? We print a bullish candle here, we print another bullish candle here, another bullish candle here, and then we get a massive candle like this, doji. What does this show you? That we open the price here and the sellers stepped in immediately. They push the market way below to this far, like to this area, like engulfing almost 2 to 3 candles this side. You can see, guys. And then what happened? The buyer stepped back in and they pushed the market back to the opening price. If I am in this trade, I will run. Like, I'll get out immediately this candle closes. You see, because definitely, most likely, the candle which is coming here is a bearish candle. This shows you that a lot of bears have interest in this market. Though the buyers are still interested, a lot of bears have stepped in and they are looking at the price up here very closely. So if you're a scalper and you're still in this trade, they will wipe your account. Seriously. Same psychology applies here, that we open the price here, and what happened? The sellers tried to push the market below here, and the buyers pushed the market all the way to the top. You can see, guys. And then the sellers stepped back in again to bring the market back to the opening price. You can see, guys. So in this case, if you are in a downtrend and you see this kind of candle happening here with this kind of buyers stepping into downtrend, be very careful. Know who is behind that move. And once you have an idea, this is what we call price action. Like every candle relays, it relays the psychology of the traders who are pushing the price. You can see, guys, you see such kind of a candle and you know, somebody is manipulating this price. Somebody is behind it. There are buyers down there. And you know that at that price, guys, look at this level here. And you know that if the price comes back to this level, it's a good point to get out. You see, if it goes beyond, it may not push so far, maybe up to around this area here, and then the price will reverse. Very easy. But that's how things happen. Okay, guys. So, guys, I think let's end here. These are already candlestick patterns. We've looked at the candlestick types. Let's brush through them again. We've looked at the type of a candlestick, what a candlestick is made up of, the psychology of a candlestick. We've looked at a hammer, types of hammers, a hanging man, a shooting star, an inverted hammer, a doji, and most importantly, the psychology of the traders behind that candle. What it really is going on behind that candle. Guys, learn how to put that always in your head. Whenever you are sitting behind a chart and you're reading price action, look at these candlesticks as buyers and sellers. And once you start to correlate that kind of psychological correlation between the buyers and sellers. You can always know when the price is going to turn around, when the price is entering a range, and when the price is taking off. Very easily, guys. Just the few candlesticks I've talked about, they're enough to tell you what is happening. Now, to the next lessons, we shall be adding on candlestick patterns. And in those patterns, we shall be looking at morning stars, evening stars, dark shadows, different types of patterns, which can give you more, I can say, which can give you further story of what really is going on in the market. And guys, in trading is not supposed to be difficult, but take it as any profession. You don't, if I studied medicine, for example, and the first time we went to study in, the first time we went to the hospital in first course, we studied biology, we studied chemistry, we studied biochemistry, we studied history, we studied philosophy, we studied other subjects, key subjects. When we came from high school, we looked at these subjects as, well, we are done with them. But we studied with those subjects and started with them. Why? To give us a basis, to give us a foundation, to give us a concrete foundation on which to build our future, our career, to create a doctor. You understand, guys? Same applies with trading. Don't jump into strategies without knowing the psychology behind each candlestick and what each candlestick means. When you jump these stages, it's like getting a person who came into medicine from first course and taking him to the sixth year to start operating on somebody. What do you expect? Of course, he's going to kill someone. There is no question about that. So, guys, don't jump, don't skip areas, and don't jump from one lesson to another because you feel it's taking so long. No, begin carefully, study candlesticks, write some notes down, put them on the wall. If you're really into it, you can even put it on the wall, and always remember to revise it, guys. That's how we study. Take some time and remember what you've studied. Then move on to the next topic. Like that, like that, like that. Within a year, maximum within 2 years, you should be making money. But don't rush trading because you want to make money in a month. No, you will lose money. So, guys, take trading seriously. Don't and don't think of trading like anything else, like a fast get rich. How is it even called? Sorry, like a scheme for you to get rich fast. No, it's just like any other profession, and it's one of the most paid profession because look at managers on Wall Street. They are traders like you, but they have been trading for the past 5 to 10 years. And how they get that experience? They keep on studying, revising, revisiting the same material. Just like a doctor, just like an engineer, just like any other profession. So, guys, if you're here to make quick money within a month, forget, don't waste your time, guys. Just stand up and go to the farm. Go back what you're doing. If you're farming, go and farm. If you're, I don't know, if you're selling something somewhere in the market, guys, go. You just waste your time and lose money here. Okay? So, guys, that was it for today. Don't forget to subscribe to this video. Please show YouTube that you like such kind of content. Drop a like, and yeah, I have a Telegram channel. I post my signals there, guys. Go and check it out. Check my actually just right now. Just go and check my channel description for this YouTube channel. You'll find my contacts there, FX Fabric, and you'll find my Telegram contacts there, and then Telegram channel, and then join. Okay. The other thing is I have mentorship. I can take you deeper into this trading concepts, and also monitor your trading. You make your trades, I monitor them and revise them with you and show you your mistakes. My mentorship takes from 5 to 6 months around, depending on how fast you study. So, guys, another thing is I also have account management. If you have trouble making money and you're new to trading, yeah, I can trade for you. All I need is MT5 logins, no access to your funds, just MT5, and we share 50-50. Okay, so guys, that is it for today. A few days from now, I will post the next video on candlestick formations and how to read them and how they work. All right, guys, have a nice trading week. Bye bye. Ай, блядь, сколько минут вообще?
40.